Between 6:49 a.m. and 6:50 a.m. on the morning of March 23rd, roughly 1,200 oil futures contracts changed hands in a single 60-second window, carrying a total value of $580 million. CBS News, the average volume for that same time of day over the previous 5 trading sessions was about 700 contracts. There was no scheduled announcement, no government data release, no speech, nothing public that could explain it. The only explanation that fits is the one nobody in power wants to say out loud, and the pattern that produced this moment goes back much further than one Monday morning. If you want to understand how deep it runs, keep watching. The trading was especially bizarre because there were no major news items, no major publicly available news items to drive sudden big market transactions. CBS News, as Nobel Prize-winning economist Paul Krugman wrote 2 days after it happened. Krugman had a word for what he thought he was looking at. That word was treason. To understand why someone would use a word that strong, you need to understand what oil futures actually are, and why 60 seconds in a single market can move the economy of an entire planet. An oil futures contract is a bet on what oil will cost at a future date. Traders buy and sell these contracts all day, every day, on exchanges in New York, London, and Chicago. When something happens that makes oil look like it is about to get cheaper, a peace deal, a ceasefire, a reduction in military tension, the price of those contracts drops fast. Anyone who held a contract betting on lower prices before the news hit would cash out with enormous gains. The contracts are worth huge amounts of money. Moving 6,000 of them in 60 seconds is not an accident. Here is the question that should stay with you for the rest of this story. Who moved them? Nobody knows. Not yet. And that single unanswered question sits at the center of something much larger than one suspicious trade. Around 6,200 Brent and WTI. That is, West Texas Intermediate. International Business Times Brent and WTI are the 2 main global price benchmarks for crude oil. They are priced in US dollars, and every refinery, airline, military, and government on Earth uses them as a reference. Moving them requires either enormous capital or enormous competence. On that Monday morning, someone had both. Trump's post appeared shortly after 7 a.m. It said the US had been engaged in productive conversations with Iran to end the war. Oil prices fell from above $98 per barrel to around $89.50 by evening. International Business Times, the Dow Jones Industrial Average surged more than 1,000 points. Anyone holding the right position in the right market at 6:49 a.m. was already positioned to capture every dollar of that move. Traders holding short positions in oil, meaning bets that prices would fall, reportedly made over $100 million in profits within 20 minutes. INVC, in a single trading session, before the war had changed at all. Before a single ship moved through the strait. Before a single sailor went home. Think about a pension fund manager in Oslo named Eric. He'd been watching oil prices climb for 3 weeks straight as the conflict in the Gulf dragged on. His clients, teachers, nurses, retirees across Norway, owned broad market funds that moved with global energy prices. He had not slept well in days. When he opened his screen that Monday morning and saw the oil price dropping fast, he searched for the news. He could not find what had moved the market. The post from the president came 15 minutes after the price had already started falling. By the time he understood what had happened, someone else was already richer by $100 million. Eric did not know their name, neither did anyone else. Ben Schifrin, the director of securities policy at a financial reform group called Better Markets, put it plainly. The innocuous explanation is that the traders just happened to trade right before the announcement of material information. The more problematic explanation is that they knew about the announcement before they placed the trades. CBS News insider trading, placing financial bets using information that is not yet public, has been illegal in the United States for decades. The law exists because markets only work if everyone plays with the same information. When someone trades on a secret, they are not just cheating other investors, They're stealing from the entire system that prices the cost of energy, food, and transportation for every person on Earth. Koopman told NPR, "If we had a comprehensive investigation by the FBI or something like that, what other explanation could there be? There was nothing else going on that would justify large transactions at that specific moment." NPR, the Securities and Exchange Commission, the federal agency responsible for policing financial markets, had not issued a public statement as of this week. The Commodity Futures Trading Commission, which regulates futures contracts specifically, faced growing calls from lawmakers to open a formal inquiry. Margaret Ryan, the SEC's top enforcement official, had resigned just 6 months into the job, reportedly after clashing with Trump's hand-picked SEC chair over her decision to pursue cases with ties to Trump. So long, nobody was minding the store, and the store had just been robbed. But this trade on March 23rd was not the beginning of the pattern. It was closer to the end of one. And to understand how that pattern runs, you need to go back to the night before the war started. In the hours before the February 28th US-Israeli strike on Iran, 6 newly created accounts on a prediction platform called Polymarket collectively earned approximately $1.2 million by purchasing yes shares in the US strikes Iran by February 28 contract at prices as low as 10 cents. Harvard Law School Forum on Corporate Governance. Polymarket is a platform where users bet on event outcomes using cryptocurrency, everything from election results to military strikes. Unlike traditional stock exchanges, it runs on a decentralized blockchain system. That means the trades are visible to anyone who knows how to read them. The identities behind the wallets, however, are anonymous. One account, operating under the username Magamyman, placed its first trade 71 minutes before news of the strike broke, when markets implied only a 17% chance of an attack happening at all. Harvard Law School Forum on Corporate Governance. The account cashed out with $553,000 in profit. The account had no trading history before that day. A blockchain analyst named Andrew, who goes by the handle Andrew10GWEI online, found something even larger. He discovered 38 accounts that he believes belonged to a single person, which netted more than $2 million by correctly betting on the February 28th strikes. Each account placed between 4 and 10 bets with a near-perfect success rate. The user had begun preparing the accounts with cryptocurrency transfers on February 22nd, 6 days before the attack, and placed the bets on February 27th, between 11 a.m. and noon. Al Jazeera. The strike happened the next morning. Every single bet paid out. Now here is the thread that holds this entire story together. The mystery element seeded at the start. Donald Trump Jr., the president's son, is an investor in and advisor to Polymarket. Salom. The Trump administration had closed 2 federal investigations into Polymarket that were opened under the previous administration. The Trump administration also granted approval for Polymarket to open a US-based platform. The millions flowing into the market on trades connected to the toppling of Iran's supreme leader were made on an overseas version of Polymarket, outside the reach of regulators in Washington. NPR, the regulator that oversees this kind of trading, had just approved the platform. The platform was financially connected to the president's family. The trades that looked like insider deals were made on the version of the platform that no one in Washington could touch. That is not a theory. Every one of those facts is on the public record. A separate trader made nearly $1 million since 2024 from dozens of well-timed bets that correctly predicted US and Israeli military actions against Iran, winning a staggering 93% of their bets, over $10,000. Even though the events they predicted were unannounced military operations. CNN Todd Phillips, a finance professor at Georgia State University who previously advised the Commodity Futures Trading Commission, looked at those numbers and said what they meant plainly. Having win rates in the 80% to 90% range is just too good to be true. I look at this and I think something fishy is going on. CNN, a researcher at Columbia University named Joshua Mitz, along with a law professor named Moran Olfia, ran a systematic analysis of Polymarket trading across more than 93,000 distinct markets and nearly 50,000 unique wallet addresses. Their results showed that across over 210,000 suspicious wallet and market pairs, the flag traders achieved a 69.9% win rate, a result that exceeded what random chance would predict by more than 60 standard deviations. Harvard Law School Forum on Corporate Governance. 60 standard deviations. In statistical terms, that is not luck. That is not pattern recognition. That is information. The pattern had been visible since before the war even started. On the Friday before the war began, an unusual surge of more than 150 Polymarket accounts placed hundreds of bets predicting a US strike on Iran. Axios. The bets were placed. The strike happened. The accounts cashed out. No names were attached to any of them. Now go back to March 23rd and what followed the $580 million trade. Iran's foreign ministry denied that any negotiations with Washington had taken place, telling state media that Trump's comments were part of efforts to reduce energy prices and buy time to implement his military plans. International Business Times. The piece that moved the market had not been confirmed by the other side in the war. The announcement that produced $100 million in profits in 20 minutes was contradicted publicly by the government it was supposedly about. And yet, the price moved. The profits were already in the accounts. The damage to the market's credibility was already done. Krugman raised a question that had not been asked publicly in an American political context in a long time. Are decisions about war and peace in part serving the cause of market manipulation rather than the national interest? Fortune, he was not asking it rhetorically. The pattern had become impossible to ignore, spanning both traditional financial markets and fast-growing prediction platforms. Democrats favored to win the House in November were already laying the groundwork for investigations into whether insiders were trading on Trump's market-moving decisions. Axios Senator Chris Murphy introduced a bill in Congress called the Banning Event, Trading on Sensitive Operations and Federal Functions Act. Its premise was simple: you should not be able to place a financial bet on whether your own country goes to war. The bill would prohibit platforms like Polymarket and its competitor Kalshi from allowing bets on government actions, terrorism, war, assassination, and events where an individual knows or controls the outcome. Al Jazeera. The bill was introduced. It had not passed. The trading continued, and there is one more data point that has not been widely noted. Trump's sons Eric and Donald Jr. had invested in drone companies competing for Pentagon contracts. Jared Kushner, the president's son-in-law, serving as one of his Iran envoys, was seeking to raise billions for his private equity fund from Persian Gulf governments that were directly entangled in the war. Axios. The people negotiating the war were also building businesses connected to it. The platform where the most suspicious trades happened was funded by the president's son. The enforcement agency that should have been investigating the trades had just lost its top prosecutor. 22 years ago, a woman named Martha Stewart was convicted of insider trading for saving herself roughly $45,000 by acting on a stock tip. She spent 5 months in prison. The punishment struck many people as excessive. Salon. She became the most famous case in a generation for the principle that no one is above the law when money is made on secret information. The trades placed on the morning of March 23rd were worth more than 12,000 times what Martha Stewart avoided losing. The people who made them have not been named. No charges have been filed. No investigation has been announced by the agencies with the power to act. The market that is supposed to be blind, that is supposed to price the future based only on public information, had been trading on the plans of a government at war, possibly for months, and possibly from within that government itself. The 60-second window between 6:49 and 6:50 a.m. on a Monday morning in March did not create this problem. It revealed it. And as of today, the answer to the only question that matters, who moved those contracts and how did they know, has still not been spoken aloud by anyone with the legal authority to find it.